welcome Anand Tandon, independent analyst, on the show right now. Hi, Anand. Good to be speaking with you. First up, give us your take on the markets. Seeing like a bit of a recovery. The broader markets are also participating in this one. But what is interesting? What is looking interesting to you right now?
Not a lot. Yes, the market is looking a little oversold, and therefore it is possible that you will get a mild recovery. I would hesitate to rush into buy. I think there are structural problems now in the Indian market, primarily among them being the IT sector. You have to remember that for the last 2 decades, the biggest driver for domestic consumption is actually the number of people who are employed in that sector. That now seems to be behind us. What are you going to do when you have 2 lakh people who are being added to the IT workforce, not being employed anymore going forward, and perhaps some of them slowly being laid off? That is a problem that is not receiving enough attention, and I don't think it's a cyclical issue. It's a structural problem. We need to find another industry which can grow in the same way. Till we do that, I think you will find that the market will go searching for lower levels as we try and adjust for lower expected earnings and perhaps a slower growth in the overall economy.
Okay, Anand, stay on with that thought. Just going to get back to you. But let's just shift focus to a very interesting note coming in from ICICI Securities and the food delivery majors, Swiggy and Zomato, even as they maintain their buy stance on both the counters. The brokerage firm has actually flagged off some concerns with regards to the cash burns in the QCOM segment, especially after Dipinder Goyal's tweet. Let me take it across to Snehi and get all of that perspective in. Snehi?
Absolutely. So interesting note coming in from ICICI Securities on two of the quick commerce and food delivery majors, Swiggy and Zomato. For Swiggy, they've reiterated their buy rating with a target price of 740 rupees per share. And for Zomato, they've reiterated their buy rating with a target price of 310 rupees per share. One of the most important points that they are highlighting is that food delivery segment is being completely ignored by investors, and that is leading to a lot of pessimism when it comes to both of these stocks. Now, they have said that they have analyzed long-term historical data, and it suggests that every time there was a noticeable tax cut announced in the union budget, consumption was had noticeably gone up in those years, the likes of FY6, FY11, FY13 and FY14, which is why they also believe that when this budget cut has been announced for our FY26 budget, consumption could go up and it could help companies like Swiggy and Zomato. Also remember that when the Q3 numbers came out, quick commerce was a segment that was under pressure, but other than that, food delivery as a segment has done well for both of these players, Zomato as well as Swiggy. They also say that concerns have been overbaked for the stock prices for both Swiggy and Zomato. Concerns were regarding the increasing cash burns in the quick commerce segment due to higher discounting by Zepto. Today we've seen a comment coming in from Adit Palicha as well, who is disregarding Dipinder Goyal's statement on how much cash the company has been burning. Swiggy's on the consolidated view is now trading at an average 30% discount to par value for the food delivery business, and this implies a negative value for the optionality success in quick commerce. Zomato on the other side is trading at a value that ascribes nothing to quick commerce business, which is why the main crux of both of these businesses lies in the food delivery segment going ahead. What ICICI Securities is also pointing out is that the anomaly is unlikely to sustain for a long time, especially given the robust outlook for discretionary consumption in May of this year, which is when this budget impetus will start kicking in and will start showing some effect in consumption. So overall, that's the note coming in from ICICI Securities, positive for both Swiggy and Zomato.
All right, so that's the ICICI Securities take on both of these measures. But Anand, help us with your take on Swiggy as well as Zomato. They have already witnessed quite a bit of correction. What are your thoughts on the same?
Two things. First is, if you look at quick commerce, what exactly is the moat other than the fact that you have a lot of money? That's been a challenge that I have not been able to understand quite clearly. So it's a question of you being able to execute at very thin margins a business which theoretically can grow very large because there is supposedly unlimited demand. Now you put that in the context of where I just, in my earlier remarks, I had mentioned that I expect to see a slowdown in terms of domestic consumption going forward. And then suddenly some of these things don't look that attractive anymore. As I said, my biggest fear is we have a structural issue on our hands. We are not generating high-paying jobs. And IT was the key driver of almost everything in terms of middle-level salaries that you were expected to get. It isn't happening now, which will mean that things like discretionary consumption, despite the cut in the income tax, etc., will not be as effective. And going forward, we need to find another industry which will replace it. I am not that bullish on domestic consumption for the moment.
That bullish within the domestic consumption pact, but Anand, don't you feel that now our day-to-day life has been impacted the most in terms of what the kind of comfort we are getting from these platforms like Swiggy and Zomato? And when I talk about aviation as well, the number of flyers that we have right now and the number of people that are choosing flights over railways has gone up ahead. Help us with your take that don't you feel that some pockets within consumption still have value in terms of the growth?
There is no value in the Indian market even today. Let us be clear on that. That said, will consumption absolutely vanish? No, we are still a economy which continues to grow and have people. And as people come up the curve, they will be spending. So it's not like one is arguing for consumption vanishing. What one is saying is that to be able to grow sustainably in a way that can benefit the stock market for companies which are trading at 60, 70 P 5 years from now, you need to have a kind of growth rate which is exorbitant. You need to have companies being able to deliver upwards of high teens or maybe mid 20s kind of numbers in terms of volume growth, not just in terms of being able to expand a new place without earning any money out of it. That has to be a natural progressive growth. There aren't too many businesses along that lines that can actually deliver that. You can see that whether you are looking at two-wheeler sales, whether you're looking at even regular FMCG kind of sales. Where is the growth? The volume growths are all tepid. They are mid-single-digit volume growths. And I'm saying this is without the effect of IT vanishing as an earning source for most people. That will go and drive that demand growth even lower. As I said, it's not that I'm saying your demand will vanish. All I'm saying is that the growth is such that the market has to correct a lot more.
Rates, and the biggest talking point of the day is definitely the tariff impact and its implications. So let's understand the impact of US tariffs on the chemical space, and Sharad joins in with the analysis. Take it away, Sharad.
Well, important tariffs have been imposed by US when it comes to China, but largely the Indian players, what we are hearing from the street is the impact is not ascertainable right now because there might be a series of retaliations coming against both the countries. Now, of course, India is an important player in the chemical ecosystem as well, and as per our channel checks, it suggests that Vinati Organics, that's roughly 31% of the exports, and Naveen Fluorine, 21% of those exports, are having no major competition from China in the US. Also, interestingly, no significant benefits from US tariffs are expected to come in, as most of the chemical companies in the recent Q3 con calls have stated nothing as such when it comes to the benefits. Currently, if you look at it on a macro basis, most of the chemical companies are working for the backward integration, and also there is a sustained supply of Chinese products as well, hampering the raw material market. So on a domestic basis, of course, the government is looking at more anti-dumping duty, but this is a very developing story as how the tariff arbitrage will play out between US, China and India, and what would benefit the Indian chemical players. Now, setting up a chemical plant in the US is almost 1.5 to 2 times costlier, making the local manufacturing in US less viable. So there might be opportunities when it comes to the Indian chemical players, but it's a developing story and we'll be getting you more impact analysis as announcements come.
Right. Okay, Sharad, we'll leave it at that. In the meantime, it's clearly the commentary on tariffs has sent jitters across world markets. But what do experts have to say about that? The potential impact of these tariffs and, of course, the way forward too. Let's listen in.
The fact that we are now in an open trade war tells you that it's not going to end just with Canada, Mexico, and China. If he's going to go all out against these guys, please let nobody think he will not come after lots of others. If you ask me, what he is doing is disastrous for the USA as well as the global economy. I mean, that would be my view. Mr. Trump seems to think that because on his last occasion, when he put up some tariffs on steel and aluminium, there was no great rise in inflation. And because there was no great rise in inflation, he seems to think that he will get away with it this time too. I'm afraid the situation is very different.
Series of concerns which is being expressed. One started from high valuations. Indian market has been one of the best performing market across the board. Indian markets have done well respect to the market cap, and having seen a significant rise, there was some expectation that this valuation is not sustainable. if there is a slowdown in the overall momentum and the growth momentum. Market knows a little bit ahead of time in terms of price correction. That's why what I feel the correction that we have witnessed is largely, I think, pricing in most of the uncertainties it has been created. I would say we are on the last leg of uncertainty.
The Chinese leadership has said a tariff war doesn't help either of the sides. It harms both. So I think that is where it will end. But the time frame for its ending, whether it's going to be 6 months or 1 year, one doesn't know.
We have a very strong long-term view on India. A lot of investment into India is based on index funds. And to the extent that retail investors and some institutional investors are selling their emerging markets funds or their Asia funds in general, that's going to affect India.
Okay, that's some expert opinion coming in and what they make of the impact of tariffs on the world. But Anand, just coming back to your point on India, the fact that you were calling it a structural, meltdown of sorts, where do you think is a safe haven right now? And is it equities at all, or would you recommend just sitting on cash or maybe some other asset class?
Well, there are no other very good asset classes to sit on. At the end of the day, if you look at, for example, what tariffs do, if the tariff is on a product which is inelastic in demand, it actually hurts the country which is putting the tariff because, they will see inflation. By and large, take pharma, for example, where will the US buy from if they don't buy from India and China? So therefore, they have to continue to buy, which means that the product will be sold at a higher price. If inflation in US becomes sticky, what do they do with their interest rates? They can't cut it down. We already have a very weak currency in India. If the US cannot bring the interest rate down, neither can we, because we're already having a problem keeping a currency where it is. A weaker dollar, slower growth, and money going out of the system doesn't behave well for currency stability. So therefore, you'll have to leave your interest rates higher, which will mean that you will not be able to have the monetary policy helping in terms of pushing up demand. Now, if the interest rates also remain higher, yes, new flows into debt may actually do better, but the older money that is in the debt is actually having perhaps a mark-to-market loss. Overall, what I'm saying is that there are not too many assets right now which are looking very attractive. You have to lower your expectations from the market, whether debt, equity, or real estate, and assume that we've had a great 4-5 years of run. From now on, you will have some normalized return, which will be perhaps subpar till the next cycle starts. At the end of the day, markets are cyclical, and the market participants have to realize that.
So not many choices left when it comes to the asset allocation right now. That's the take coming in from Anand. But just a few minutes left before we shut shop, and it's been a decent day, at least for the banking index. Some of these banking majors like SBI, IndusInd, they tried to send some bit of a support to the banking index. Nifty Bank is up around 180 points right now, and Nifty 50, at least for today, was able to defend that 22,000 mark. But before we close the day, let's also get in some BTST ideas from our experts. And Kunal, tell us any stock for the BTST or STBT trade?
Yeah, I'll suggest two buy calls, and the first one is around Bandhan Bank. Even after this 4% plus kind of a move, the stock is now challenging its 50-day moving average. And looking at the indicators, the breakout could probably be happening for the stock over the very near term over the next couple of days. So anticipating that and suggesting a buy with a short-term target of 150, stop loss to be kept at 139. And the second is a buy on BHEL. It's more of a contra buy, the stock which has been beaten down significantly, more than a 40% plus correction over the last 6 to 7 months. Apparently just on the sub 200 mark, 190 levels thereabout. The stock looks to be a good contra buy at current levels, risk reward fairly attractive. Look out for targets in the range of 204, stop loss to be kept at 184.
So those are the two buy calls coming in on two stocks. One is the banking stock Bandhan Bank, one of the underperformers, seeing a good day today, and BHEL is another stock. But Naresh, what about you? Do you have also some of these buy calls, or would you like to hedge with some of the selling ideas as well?
So two buy ideas. First is a buy on PFC. The stock has corrected a lot and shaping up for a bounce back. Stop loss at 378, target price of 395. Second is a buy on Indigo, which clearly is a relative outperformer and on verge of a breakout today. Stop loss at 45.50, target price of 4,700.
That's the take coming in on some of those interesting trading ideas. In the meantime, oil and gas definitely is going home a winner today, and today is a lot more stable as opposed to what we've been used to of late. Infrastructure, cap goods, textile, pharma have all seen a rebound today.